Starting in 2020, the traditional metrics of investing, things like fair valuations and solid fundamentals, were completely thrown out the window. People began pouring money into companies trading at 650 times their actual earnings. Cautious investors who stuck to the old math found themselves lagging behind. Meanwhile, traders riding online hype cycles and throwing capital into random crypto meme coins were making staggering profits. It reached a point where legendary investor Warren Buffett observed, you really had to ask yourself, why buy Apple when you can buy Fartcoin? For a brief window of time, absolute irrationality became the single most profitable strategy on Wall Street. Meet Dave. Dave has been trading for about 2 years, which in market terms makes him the equivalent of a toddler who just discovered fire, but his confidence is absolute. His strategy relies entirely on hype and prayer. He does zero research. He simply calls his broker, lies about his net worth to get approved for options trading, and maxes out his leverage on extremely risky bets. Despite breaking every rule of risk management, Dave's portfolio is up 13% this year. He is actively outperforming seasoned professional funds. Have the established laws of finance stopped working, or is there a specific mathematical mechanism secretly driving Dave's success? Dave now spends his time at bars calling himself a market wizard and explaining biotech trends to anyone with a pulse. He has fallen into the trap of the Dunning-Kruger effect, where a small amount of early success creates a massive, distorted sense of mastery. But if we pulled back from Dave's trading app, a much larger macroeconomic picture emerges. We have been living inside a relentless, continuous upward run. This chart shows the scale of that run. Over a 17-year span starting in 2009, the market generated a massive 715% return. In this artificially prolonged rising tide, the underlying quality of individual stocks stops mattering. Any long position is mathematically destined to rise. This environment aggressively rewarded the highest risk behaviors and warped investor psychology on a mass scale, which brings us to the actual math behind Dave's massive returns, a metric called beta. Beta is simply a measure of how volatile a specific stock is compared to the overall market. This graphic shows how it works. If the baseline market is 1.0 and Amazon has a beta of 1.33, Amazon shares are 33% more volatile. With that multiplier, if the overall market rises 2%, Amazon mathematically jumps 2.66%. Dave isn't carefully selecting winning companies. He has simply built a portfolio packed exclusively with these ultra-high beta assets. In a surging bull market, high beta acts as a massive upward multiplier. It inflates your returns so fast that a retail trader starts feeling like George Soros. Dave's outperformance is a mathematical byproduct of high-risk assets meeting a persistent upward trend. But momentum requires fuel, and the bender finally hits a wall when the Federal Reserve decides to hike interest rates. Jerome Powell's decision immediately shifts the macro environment, causing the broader market to pull back. This chart shows the dark side of that volatility metric. A minor market drop heavily multiplies losses for any high beta portfolio. For Dave, gravity takes hold, and his portfolio collapses by 67%, wiping out his gains. Rather than accept the mathematical reality of his trades, Dave refuses to take the blame. He insists his calls expired worthless because of market makers or shifting political winds involving Donald Trump. This blame shifting is a necessary coping mechanism. Taking massive losses on the chin simply doesn't fit into the retail trader fantasy. High beta stocks are a powerful psychological drug. Because they multiply market moves, they provide an intoxicating, if temporary, sense of personal genius that safer investments can't match. Anyone can look like a visionary riding high beta upside in a historic bull market. True investing is entirely about surviving the gravity of the downside.